In 2025, the average age of a home buyer in the United States hit 59 years old. 15 years ago, it was 39. Read that again. Not the age people dream of owning a home, the age they actually do it. 15 years ago, someone could buy a home in their late 30s, right in the middle of raising a family. Today, by the time the average person gets the keys, their kids are already grown. But here's the part that doesn't add up. The U.S. economy has never been bigger, the stock market has never been higher, corporate profits have never been fatter. So if there's more money in the system than ever before, where did it go? That's loop number one. Hold on to it. Here's loop number two. If you ask most people why they can't get ahead, they'll blame themselves. Not enough discipline, not enough hustle, bad decisions. But the data tells a very different story, one where the game changed underneath an entire generation and nobody rang a bell to announce it. And loop number three, something did replace the old American dream. It's not a house with a white picket fence anymore. It's something stranger, riskier, and, for a small number of people, far more profitable. We'll show you exactly what it is, but that's only part of the story. Why this matters. This isn't just a story about houses. Home ownership has always been how ordinary American families built wealth, not through salaries, but through equity. You bought a home, the value slowly climbed, and 30 years later you had an asset worth passing down. Take that away, and you don't just lose a house. You lose the machine that built middle-class wealth for 3 generations. And it's not only about buying, it's about renting too. It's about whether your job pays enough to save anything at all. It's about whether your kids will do better than you, which, for the first time in modern American history, most parents now doubt. This affects almost everyone watching this video. Whether you're 22 and just starting out or 45 and wondering why you're not further ahead, this story explains why, using numbers, not opinions. How we got here to understand what broke, you have to see what used to work. From the end of World War II until the late 1970s, something unusual happened in America. As workers became more productive, meaning they produced more value per hour worked, their pay rose right along with it, line for line, almost in lockstep. That one relationship is what built the post-war middle class. A single income could support a family, buy a modest home, and retire with a pension. It wasn't perfect. Plenty of Americans were excluded from it by discriminatory housing and lending policy, but for those inside the system, the math worked. Then, around 1979, the lines split apart. According to the Economic Policy Institute, from 1979 to 2025, productivity, the value each worker generates, grew by roughly 90%. Typical worker pay, adjusted for inflation, grew by only about 33%. If pay had kept pace with productivity the way it used to, the average worker today would be earning over $16 more per hour than they actually do. That gap didn't come from nowhere. A mix of factors drove it. The decline of labor unions, policy choices that favored capital over wages, and a shift in how corporate profits get distributed, increasingly toward shareholders and executives rather than the workers producing the value in the first place. Wages stopped being the main engine of middle-class wealth. And around the same time, something else started happening to the other engine: housing. The housing math. Nobody shows you in 1970 the median home price was roughly 2.2 times the median income. In 1990, it was about 3.2 times. Today, nationally, it's close to 5 times, and in expensive coastal metros, it can be 8 to 12 times the median income. Here's a simple way to picture it. Imagine your income is a ladder, and the cost of a home is a shelf you're trying to reach. In 1970, that shelf was about waist high. Today, in many cities, it's above your head, and it keeps rising faster than the ladder grows. According to Harvard's Joint Center for Housing Studies, between 2019 and 2024 alone, median home prices rose by about 48%, while median income rose by only about 22%. The gap didn't close, it widened, fast. And the people most locked out are the ones who need a first home the most. According to the National Association of Realtors, first-time buyers made up just 21% of all home purchases in 2024, a record low, down by roughly half, compared to right before the 2008 financial crisis. Real people, real numbers. Picture a 29-year-old with a college degree and a full-time job. In 1983, someone in that position could realistically buy a median-priced home on a median income. Today, according to housing economists, that same 29-year-old would need either a dramatically higher income, a decade of extra saving, or a cash gift from family just to reach the same starting line. That last part matters more than people realize. Redfin's research shows that nearly 1 in 5 millennial homebuyers received a cash gift from family to help with their down payment. That means for a huge share of buyers, homeownership isn't just about hard work anymore. It's about whether your parents happen to have money to give you. Now picture a retiree who bought their home decades ago. They're sitting on enormous tax-advantaged equity, often with a mortgage rate locked in near 3%. Selling means giving that rate up. So many simply don't sell, which shrinks the supply of homes available for everyone else and pushes prices up even further. Now picture a small business owner. Rising commercial rents, higher borrowing costs, and squeezed consumer spending all hit at once. The dream of owning your own business now competes with a completely different economic climate than the one their parents built businesses in. Different people, same underlying math. Why smart people still get this wrong? Here's where psychology comes in. Most people, when they fall behind financially, blame themselves first. Economists call this a fundamental attribution error. We tend to explain other people's failures with circumstances, but explain our own failures with character flaws. I should have saved more. I should have worked harder. But when the underlying math has shifted this dramatically, wages decoupled from productivity, home prices decoupled from income, individual effort matters less than the system people are operating inside of. There's also a media bias problem. Headlines love extremes. Either the economy is booming or the economy is collapsing. The truth is messier and less clickable. The average is doing fine, while the median, the typical person, is falling behind. Averages get pulled upward by a small number of very wealthy households, which hides how the middle is actually doing. That single confusion, average versus typical, is responsible for more bad financial takes than almost anything else in personal finance media. 3 futures. So where does this go from here? Economists broadly point to 3 scenarios. Best case, interest rates ease, housing supply increases meaningfully, and wage growth in high-demand sectors like skilled trades and healthcare outpaces inflation for several consecutive years. Affordability slowly improves, especially outside the most expensive coastal metros. Worst case, housing supply stays constrained, institutional and cash buyers continue to outcompete individual buyers, and the wealth gap between homeowners and renters keeps widening across generations. Most likely case, according to most housing economists, a slow, uneven improvement. Some metros get more affordable. Expensive coastal cities largely don't. Home ownership increasingly depends on either family wealth, relocation to lower-cost areas, or income growth well above the national average. None of these scenarios bring back the version of the American dream that existed in 1975. That version required a very specific set of economic conditions that so far haven't returned. What actually replaced it? So if the old dream, one job, one house, one retirement, isn't the reliable path it used to be, what is replacing it? The data points somewhere specific: income diversification. By 2025, an estimated 70 million Americans, roughly a third of the workforce, were earning money outside a single traditional job, through freelancing, gig work, or a side business, according to multiple labor market surveys. For many, this isn't a side project anymore. It's a deliberate strategy to avoid depending on one employer, one paycheck, one source of security. This isn't purely a positive story. A large share of side hustlers say they're doing it out of financial necessity, not passion, and burnout is common. But structurally, it represents a real shift. Security now increasingly comes from multiple smaller income streams and building skills that transfer across jobs, rather than one large, stable institution promising to take care of you for life. The new version of making it looks less like a 30-year mortgage and a gold watch at retirement, and more like owning assets early, even in small amounts, building income that isn't tied to one employer, and treating financial flexibility, not a house, as the real marker of security. That's not necessarily worse, but it is a completely different game with different rules, and most people are still playing by the old ones. What viewers should actually do with this isn't a call to give up on homeownership or traditional careers, those still work well for many people. It's a call to stop measuring yourself against a version of the American dream that operated under completely different economic conditions. A few shifts worth taking seriously: build savings and investing habits early. Even in small amounts, time in the market matters more than timing it. Don't assume one employer is your entire financial safety net, and separate what's within your control, your skills, your savings rate, your spending, from what isn't, like interest rates or housing supply. Confusing the two is exactly what turns a structural problem into unnecessary self-blame. The American dream was never really about a house. It was a promise that if you worked hard and played by the rules, the system would reward you for it. For decades, that promise held. Then, quietly, the rules changed, and the rewards stopped showing up the same way. The people getting ahead today aren't necessarily working harder than their parents did. They're playing a different game with a different scoreboard. The house on the hill was never the point. It was just what security used to look like. The real question isn't whether the old dream is dead. It's whether you're still trying to win a game that isn't being played anymore. If this documentary gave you a new way of seeing money in America, subscribe, because we're going to keep breaking down exactly how this economy really works, one story at a time.